Welcome back, Tried and True Tribe. Today, we're going to discuss navigating charitable giving donations. So if you've been in business for years or you're just starting your entrepreneurial journey, this video is for you. Charitable donations made by small businesses can have a significant tax implication, offering a way for businesses to give back to their communities while potentially reducing their tax liability. Here are some key points to consider. In the United States, businesses can make qualified charitable contributions, and these donations are deductible on your business tax return. The business must be organized as a sole proprietor, a partnership, a S Corp or LLC, taxed as a sole proprietor or partnership. C corporations can also deduct charitable contributions, but there are some specific limits, usually about 10% of your taxable income, that may apply. To qualify for a deduction, the charitable donation must be made to a qualified tax-exempt organization. And just for extra peace of mind, you can always double check to ensure that the charity has the proper tax-exempt status by checking the IRS's exemption organization checklist tool. You'll also want to make sure that you keep detailed records of all charitable contributions, including receipts and acknowledgement letters that you'll receive from these charitable organizations, because proper documentation is crucial when claiming deductions. Small businesses can also donate goods or services instead of cash. For example, a local bakery could donate baked goods to a charity event. The fair market value of those donated goods or services can be deducted. You can also encourage your employees to volunteer for charitable organizations. So while the time volunteered isn't deductible, some expenses related to the employee volunteer programs is what may be deductible. For instance, like the cost of uniforms worn during the volunteer work or transportation expenses for employees volunteering at charitable events may be deductible. Those are some things you want to keep in mind. And if a business sponsors a charitable event or makes a donation in exchange for advertising, the advertising expenses may be deductible as a business expense. Additional deductions may even be available for contributions made for qualified disaster relief efforts. This can be especially relevant for small businesses that are located in disaster-prone areas. Make sure that you are informed of the limits on charitable contributions, as they may change from year to year, as the tax code often does. Generally, the deduction for charitable contributions is limited to a percentage of the business's adjusted gross income, or AGI. Any excess contributions can be carried forward for up to 5 years. Tax laws and regulations regarding charitable contributions may vary at the state and local levels also, so that's something to keep in mind. So it's essential to understand and comply with the local tax requirements. Consult with a tax professional or an accountant who is familiar with small business tax laws. They can provide personalized advice based on the specific circumstances of your business. By strategically incorporating charitable giving into a small business plan, entrepreneurs can not only make a positive impact on their communities, but also potentially realize amazing tax benefits. It's a win-win situation, but I urge you to always consult with a tax professional to ensure compliance with the current tax laws and regulations. And when it comes to charitable donations, there are several common pitfalls that individuals and businesses should be aware of to ensure that you're maximizing your benefits for those contributions. Here are some pitfalls to avoid. Number 1, failure to verify the charitable status. One common pitfall is not verifying the tax-exempt status of the charitable organization. To qualify for a deduction, donations must be made to an eligible tax-exempt organization. You can use the IRS's exempt organizations select check tool to confirm the organization's status. We'll be sure to drop the link in the description. Number 2, inadequate documentation. Proper documentation is crucial when claiming charitable deductions. And failing to keep detailed records, including receipts and acknowledgement letters from the charitable organization, can lead to difficulties during tax audits and possibly resulting in denying the deduction. And we don't want that, do we? Number 3, overstating the value of non-cash contributions. So when donating non-cash items, accurately assess the fair market value, because overstating the value of donated goods or services can also lead to penalties and may jeopardize the deduction. Number 4, ignoring contribution limits. Understand and adhere to the contribution limits based on your adjusted gross income, or AGI, because exceeding these limits without proper planning may result in lost deductions. And number 5, not checking state regulations. State regulations regarding charitable deductions can vary. So be sure to check and comply with any state-specific rules to avoid any potential issues. Number 6, contributions to non-qualified organizations. Donations of certain types of organizations, such as political campaigns or individuals, are not eligible for charitable deductions. Ensure that your contributions are directed to qualified tax-exempt entities. Number 7, deducting volunteer time. So while the value of the donated service is not deductible, some expenses relating to volunteering may be. For instance, the miles you drove to volunteer your time could be deductible, as we mentioned earlier. And keep in mind that it's essential to understand the specific rules governing these deductions. Number 8, quid pro quo contributions. So if a donor receives goods or services in return for a contribution, i.e. quid pro, this for that, the deductible amount is generally reduced by the fair market value of what was received. Be aware of these rules when making contributions tied to events or fundraising campaigns. Number 9, unplanned employee volunteer programs. So while encouraging employee volunteerism is a positive step, not understanding the tax implications of related expenses could lead to unexpected tax consequences. Consult with a tax professional to ensure compliance. Number 10, donating highly appreciated assets without consideration. So donating appreciated assets can have tax advantages, okay? But it's important to carefully consider the implications. In some cases, selling the asset and donating the cash may be more tax efficient. You just gotta weigh the pros and cons. Number 11, failing to seek professional advice. It's no secret that the tax laws are complex and subject to frequent change. So failing to seek professional advice from a tax accountant or enrolled agent can lead to missed opportunities or unintended tax consequences. So by being aware of these pitfalls and taking a proactive measure to address them, you as a business owner can navigate the charitable donation landscape more effectively and maximize the impact of those positive contributions. Always, always, always consult with a tax professional for personalized guidance based on your specific circumstances. Now, if you found this video helpful, please hit that subscribe button, give it a thumbs up, and drop any questions you have in the comments below. Until next time, stay financially savvy, and thanks for tuning in to Tried and True Financial Services, where our core mission is to empower entrepreneurs by providing them with the knowledge and strategies to gain better control over their finances while upholding the highest standards of ethics and integrity. Bye for now.